Hey, this is Sasha. Thanks for joining me in today's video. Today, what I want to share with you is a little concept about when to do shorter term duration trades and when to do longer term duration option trades when it comes to doing option spreads. So we're going to take a look at this. I'm going to share with you some thoughts and insights, some quick thoughts and insights. And of course, if you want more details, I would definitely check out some of the courses we have available or get a one-on-one coaching session. So let's check it out. All right, so to kick things off, really a lot of people have trouble deciding, hey, do I do a 15-day option? Do I do a 30-day? Do I do a 60-day? What time frame do I choose? And ultimately, when it comes to these time frames, longer, in a way, people think is better because you have more time, right? Is that correct? That's what a lot of people think, but it's not always the case. Remember, when it comes to options and the way that you make money from a couple of things, right? You make money from price. Is the price going up or down, depending on your spread? Then you make money from time, and you make money from volatility. This is kind of the value of your option. And together, hey, you might make, let's say, $10 from price, you might make $30 from time, and let's say $5 from volatility. So ultimately, where are you making the most money? In some cases, it might be time. Other instances, it might be volatility, where you have kind of one of the larger ones here, and time you might be 20, and price you might be 20 as well. So when you look at this factor, it's important to understand that different amounts of money is coming from these different areas. So you have different types of risks. These, in essence, are your risks. Okay. So because they are your risks, now as you look at time frame, the further out in duration you go, in theory, the more volatility you're purchasing as you go and purchase options. So it's important to understand, where are you making money? So let's take a look at kind of a baseline example. If we go in and let's just look at an example of, let's go Facebook here, for example. And if we look at the current chart of Facebook and we look at the S&P, it's tanking in a big way, but let's check out Facebook, right? If I'm looking to invest in this as a spread, and we could say an iron condor for conversation's sake, if I go here and I want to build an iron condor around this, like let's say something to enclose it about like that, then going shorter versus longer duration is going to really be a big difference. So let's say we go 30 days and we go sell an iron condor. Okay. And here, let's put this in. And the current price is what, 142. So the call side, let's go a lot higher here. Maybe 180, and this will be this will be 160, and this will be 180. Okay, so here we have a basic iron condor, and we'll make these a little bit more even. So there we go. So there we have an iron condor. Now, I want you to pay close attention. Let's bump it up to 5 contracts, to the theta and vega ratio. If you look at the theta to vega ratio, this trade's about a 30-day trade. If I have a volatility problem, it only takes you about a day, 1 day, to make it up, right? Because you got a 73 theta and you got a negative 57 vega. So if I had a volatility problem, then I could make it up the next day. But let's bring this trade out into January, a long-term duration trade. Now I want you to take a look at the ratio. Theta to vega. If you've got a 1-point volatility problem, that's $70. You've lost $70. And if you've got multiple contracts, it's a lot more. So how many days does it take to make that up? Well, how many times does it take 2.5 to go into 70? So it's a lot more days. The ratio is going to be, anywhere between about 30, 32, 25, because of course theta is exponential. So let's just say about 25 days, you got a 25x ratio to make up a volatility problem. And if you're dealing with multiple contracts here, like I have 5 contracts, if you go ahead and let's say we ramp up the volatility 4 points, I'm down $268. So how many days does it take to make that up, right? So you're looking at probably about 100 and some days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. And that's just from the theta side of things. So what I'm trying to get to and tell you is that it's not about longer term or shorter term, one is better than the other. It's that you have different risks involved. And the long and the short of it is when we really look at longer term duration versus shorter term duration on trades. So if we go long versus short, okay, with short-term durations, you have a faster theta, okay? You can make much more money. You make it a lot quicker through the theta decay. With longer-term duration, you have a slower theta, okay? But with shorter-term duration, because of this, you have a bigger price risk. Okay, with longer term duration, there's less pricing problem, less price risk in that case. So this is what I want you to really get to. Now, there's of course a lot of many other factors beyond just these two things, but that's what I want you to understand is that when you go longer duration on something like a spread, like an iron condor, and you go into it, take a look at your delta. My delta here is -2. Whereas if I go into a shorter duration and we go into April, look at my delta, -53, which basically means I'm going to be whipping around a little bit more on price and more concern. Whereas if I go longer duration, price is less of an issue. In this case, it's -22. If I go even further duration, I have less of a pricing problem. But again, I have more of a volatility problem. So that's what I want you to understand from this video is that to do, when you go shorter term duration, you're ultimately getting a faster theta, but you've got a bigger price risk. If you're going longer term duration, you got a slower theta, but you still have theta, but you have less price risk. So ultimately, when you go in and you're looking to go ahead and put on these trades, think about the risks that you want to have, because you will have some risks. It's just a question of what is it that you want to have. Anyways, if this video was helpful, insightful, and gave you some things to think about, go ahead, subscribe to the YouTube channel or join our mailing list so that way you get notified as we release other great updates for our courses, classes, any future books released, and much more. Thanks again, and I will see you next time.